All right, today we're going to try and solve a puzzle, and it comes from the medical tech giant Becton Dickinson, or as most people know them, BDX. Now, on the surface, their latest earnings report looked fantastic, but hiding behind those numbers is a story of a massive strategic pivot that has completely remade the company from the ground up. So let's dive in. So this is the central mystery, right? BDX comes out, they report their quarterly earnings, and they beat expectations on every single important metric. And what happens? The stock immediately tanks, dropping a whopping 17%. It just doesn't add up. It's a paradox that really spooked the market. So what on earth is really going on here? And look, this wasn't some tiny squeak-by beat. Wall Street was looking for earnings of $2.81 a share. BDX delivered $2.91. Analysts predicted $5.15 billion in revenue. BDX pulled in $5.25 billion. I mean, by any normal measure, this should be champagne-popping news. But the market's reaction tells us that this story isn't about these numbers. It was about something much, much bigger. And that something bigger is the creation of what the company is now calling the new BD. You see, at the very same time they were releasing these strong earnings, BDX was finalizing a gigantic transaction that fundamentally changes everything about the company. They spun off a huge chunk of their business. This is the real story. So how'd they do it? Well, they used a pretty complex financial tool called a reverse Morris trust. I know, it sounds super technical, but the basic idea is actually pretty straightforward. BDX essentially took its entire life sciences business, carved it out into a brand new, separate company, and then immediately merged that new company with another player, Waters Corporation. It's a clever, tax-efficient way to separate a major part of your operations. So here's how it all went down, step by step. First, they spun off the life sciences division. Simple enough. Second, they combined that new business with Waters Corporation. Third, and this is key, BDX got a massive $4 billion cash payment out of the deal. And fourth, they didn't just sit on that cash. They immediately put it to work. $2 billion for buying back their own stock, and another $2 billion to pay down their corporate debt. And you don't have to take my word for it. The CEO, Tom Poland, laid it out perfectly. He said this kicks off a new chapter where BDX is now a far more focused, pure-play medtech company. So what does pure play mean? Well, it means instead of being this sprawling giant with a hand in lots of different pies, the new BD is leaner, meaner, and hyper-focused on a very specific slice of the medical technology world. So what's the game plan for this new, focused company? Well, according to management, they are now laser-focused on cashing in on three huge trends that are reshaping all of healthcare. First, the explosion of smart devices, robotics, and AI. Second, the massive shift of medical care out of hospitals and into cheaper settings, even right into your home. And third, the booming market for new technologies that help manage chronic diseases. The company is basically betting that being smaller and more agile will actually lead to faster growth. So, with that new focus in mind, let's pop the hood and take a look at the parts of the business that are already firing on all cylinders. And here they are. These are the current stars of the new portfolio. Right now, the company is seeing really strong double-digit growth in four key areas: biologic drug delivery, their PureWick product for incontinence, advanced tissue regeneration, and automating pharmacies. This is where the new BD is putting its chips. And if you want to see just how powerful this focus can be, just look at GLP-1 drugs. You know, the blockbuster weight loss treatments like Ozempic and Wegovy that are everywhere right now. Well, DDX is a huge player in making the delivery devices for these drugs. They've got contracts for over 80 different molecules in this category. It's a pretty small part of their business today, but it represents a gigantic opportunity for future growth. Okay, so that's the sunny side of the story. But of course, it's not the whole story. The market's nervous reaction wasn't just about this massive strategic shift. It was also about some very real challenges and risks that this new, leaner BDX is facing right now. In this slide really puts those challenges into perspective. The company was very direct about this on their earnings call. They basically said, look, 90% of our new portfolio is doing just fine, growing at a nice, solid mid-single-digit rate. But that other 10%, that's where they're running into some serious headwinds that are dragging everything else down. So what's hiding in that troubled 10%? Well, it's really a mix of three things. First, ongoing costs to fix issues with their Alaris infusion pumps. Second, a predictable drop-off in demand for vaccine-related products now that the pandemic has eased. And third, Just really tough market conditions over in China. These aren't new problems, but they're definitely weighing on the company's results.
And it's not just business performance that's a concern. If you dig into the company's official filings, you'll find some pretty significant legal liabilities lurking there too.
And as you can see, the scale of these legal challenges is pretty substantial. We're talking nearly 7,000 claims related to hernia repair devices, almost 3,000 for implantable ports, plus hundreds of lawsuits tied to ethylene oxide emissions. All of this just adds up to a big cloud of financial uncertainty hanging over the company. And if that weren't enough, there's one more headwind to mention: tariffs. Management specifically called this out, saying it's a material drag on the business. It's creating a 1.7% hit to their gross margins. Now, that might not sound like a lot, but for a company of this size, that is a huge impact on profitability. So you've got all these pieces moving at once: a brand new strategy, some strong growth areas, but also these really significant headwinds and risks. So what does the company itself actually expect for the rest of the year? Let's take a look at their official guidance. So after all this change, what does BDX actually expect to earn? Well, they're guiding for their full-year adjusted earnings per share to land somewhere between $12.35 and $12.65. This range is the new baseline, the new benchmark for profitability after the big spinoff. And this table really pulls it all together, giving us the complete financial picture for the new BD. They're forecasting pretty slow revenue growth, low single digits. They're targeting an operating margin around 25%. And at the end of the day, that translates to about 6% growth in earnings per share. This is the new financial reality for investors to watch. So at the end of the day, BDX has made a massive, company-altering bet. They've traded size for speed, they've swapped diversification for intense focus, aiming right at what they see as the biggest trends in healthcare. But in doing so, they've also accepted some very real risks and headwinds. And so the big question for investors, and the real reason the stock took such a hit, is whether this leaner, more focused new BD is truly built to win, and if this incredibly bold pivot will actually pay off.